What is going on? I hope you are doing well. I hope you had a good Thanksgiving. It is that time of year where, it's the holiday season and it's almost the start of the new year, which means tax season is right around the corner. All right, so I just wanted to hop on here and talk about a few things, honestly, in some detail too, about some year-end things to do, mainly for business owners, and not just business owners, but maybe even if you're a just standard W-2 employee, some of these tax tips can apply to you as well. But I just wanted to get on here and talk about some things that you need to do, before year end in order to kind of make tax season a little bit less stressful for you. So we'll just go ahead and jump right on into this. This is going to be a part for mainly business owners. Is get your books up to date. Okay. Hopefully you're not the person who is like, you just make all the money during the year and then January comes around and then you're sitting there scrambling through receipts, totaling numbers up here, and then you got to hurry up and rush it into your accountant so they can get your taxes prepared. Well, hopefully you're able to get some time away from work during the holiday season, and hopefully you can kind of get some of these things in order prior to. It's not just going to make your actual tax season and tax filing easier, but it's actually going to, allow you to see before the year's even over with, how much money did my business make? How much am I going to make this year? What was the sales? What were the expenses? Were there any expenses that went way, way through the roof compared to last year? So, having your books up to date is not just something that's kind of needed for tax planning purposes or preparation, but don't you want to know the finances of your business? So, I just wanted to show you guys an example of basically, what a profit and loss statement should look like, and we'll just basically go from there. So what we're looking at here is a profit and loss template that we have available on our company's Facebook page and group. So basically this is what you're going to want your profit and loss statement to look like, is this right here. So basically at the top, it's pretty obvious, right? You're just going to have your total income number, whatever that, your total revenue, the amount of money that customers have paid you. And then down here you have your expenses totaled by category. And categories, depending on your business and everything, might look a little bit different. If you are a contractor who does roofing versus, an accounting firm or a dentist practice, it'll look a little bit different for your categories. But this will pretty much be what it looks like. You have your expenses, you have your amount for advertising and marketing, bank fees, any contractors that you hired for help. Maybe like I said, you're a contractor and you've got some equipment out there that takes gas. Equipment fuel, vehicle fuel, liability insurance, vehicle insurance, small tools that cost less than $2,500 per item. And this one's actually kind of important because, when you have a tool that costs $2,500 or more, then you have to basically just treat it different. Let me give you an example. So if you go out there and you buy, a nice nail gun, and the nail gun runs you $400 or $500, you can put it in this small tools expense account, and that will be just fine because there's a safe harbor rule that allows you to basically just expense any individual item that costs less than $2,500. So the alternative to that is if the item costs more than $2,500, is what you have to do is then you have to list that item as an asset, right? And then you have to depreciate it, which is basically just a different form of expensing it. So you're going to want to list out small tools that cost less than $2,500 on your profit and loss statement. And then for the items that cost more than $2,500, you're going to want to list these separately away from your profit and loss statement, just because this is going to be an asset that gets depreciated versus just a small tools expense. And then you can kind of see, just moving down, going forward again, you've got, small tools, supplies, materials, any meal expenses. And this is one thing that some business owners kind of get confused with in regards to meal expenses, right? So a lot of times we'll see people who list dollar amounts that they spent on, food, right? And then we ask them and we're like, hey, did you, have any of these meals with your customers or any of these meals with your clients, any of your employees, your contractors, potential customers, any vendors? And they say, well, no, those are just meals that, when I was working a full day and I bought myself lunch. That's not a deductible meal expense, right? A deductible meal expense is kind of what I said, in a sense that it's a meal that you paid for and enjoyed with either an employee, a contractor, a customer, a vendor, or a potential customer, or a potential vendor, or a potential employee. Those are meal expenses. You have to buy the meal for somebody else and be there while they have the meal, pretty much. So that's a meal expense. Meals bought solely for the owner while the owner is working are not a deductible meal expense. All right. And then, of course, you're just going to kind of keep moving down the list here. You've got meals, dues, and subscriptions. Maybe you have some type of subscription that you pay for every month. Office supplies and software, right? Repairs and maintenance on equipment, repairs and maintenance on vehicle. And then you've got rent and lease for equipment, rent and lease for a building, and then any taxes and licenses that you might have to pay for throughout the year. One thing to note in regards to bookkeeping and kind of labeling these things is the reason why repairs and maintenance on equipment and vehicle are separated, and then you have fuel up here between machine and vehicle separated, is because there are a lot of business owners out there who do not deduct actual vehicle expenses. They deduct the standard mileage deduction for their vehicle expenses. So to break that down, when you use a vehicle in your business, you have two ways of going about taking the tax deduction. The first way is the one that's most commonly known, is you'll get a standard mileage deduction. This is where you for every business mile that you drive, you get in 2023, 62.5 cents per mile as a tax deduction against your business income for your vehicle. So that's one route. And then the other route is your actual expenses, meaning the gas you put in it, all the repairs and maintenance to it. And then, of course, you'll be able to depreciate the cost of your vehicle as well. So the reason that you want to kind of keep those things separated is, well, one, just for financial bookkeeping things, you might want to just know where your fuel is going. Okay, was this vehicle fuel that we're spending more money on, or is it equipment fuel that we're spending more money on? Are the repairs going to our equipment, or are the repairs going to our fleet of vehicles? Those would be, just financial reasons as a business owner that you would want those things separated. And then, of course, there's the tax reason to where you might not be taking the actual vehicle expenses, you're taking the mileage deduction. So, business owners, real estate investors, first and foremost, get your books up to date. Take a look at your profit and loss statement. Okay, so you got your books up to date and you're taking a look at your net income number. Woohoo! I kind of know how much money I made for the year, right? But it's not the full year, maybe it's just January through the end of October, so to speak. And then from there, you can just kind of take a look at it and say, okay, and just from this example that we're using, we have about $93,000 in profits that we're going to have to pay tax on as of the end of October, right? So then you can kind of come in there and say, okay, what does November look like? What does December look like? And how is that going to affect my net income? And then, okay, there you go. Maybe it goes up to just over $100,000. And then, there you go. You have your number. And then one thing is that, who cares? Okay, so in this example, sorry, a little tongue-tied. In this example, you've got $93,000 of net income. And of course, what's the question? How much do I owe on that $93,000? So, of course, there's, without being a tax professional, it's going to be hard to calculate what your actual amount of tax due is. So that's where you get tax planning done, or you just, what we tell people for a general rule of thumb is somewhere between 30 to 40% of your net is going to kind of be what you owe in taxes. The more you make, the more they take. A lot of this stuff too depends on a little bit of your business structure and what type of business you have, right? For instance, if you're a sole proprietor or a single member LLC and you have an active business or you're the contractor, you're going to have to pay self-employment taxes. If you are in rental real estate, you're not going to have self-employment taxes. So, it kind of varies. So usually what we tell people is just anywhere between 30 and 40%, depending on how high their income is. Okay, So now you've got $93,000 of income, and you're saying we'll just split the difference. 35% of that is going to go to the government. So we're looking at a $32,000 tax bill. Ouch. But the good part is you're watching this video right now, so you might be able to do something about that, right? And the first thing that you're going to want to do as a business owner is go ahead and take a look at your existing business, what you did the past year, and what are your plans for next year. Are you looking at expanding your business? Or is there any new tools or pieces of equipment that you were thinking about buying maybe in April of 2024? Do you want to buy it before the ball drops? Maybe. Because that is one of, the most, I guess, common types of tax savings tips is, expanding your business, growing. Go ahead and go purchase that new piece of equipment. And then if maybe there's not, no need for you to go out and buy new, right? Maybe you're not necessarily maybe your expansion doesn't necessarily require a new piece of equipment or a new tool. Maybe you just have to repair some old ones, or maybe you are going to expand, but you already have the equipment giving you the level of capacity that you need, so you don't need to get that piece of equipment in order to meet the new demand that you're expecting for the current year. So maybe you'll just want to go in and repair some of your old equipment, right? Do that before the end of the year, because the money that you could either spend the money, I guess, in 2024 and repair your equipment in February of 2024, and then you have to wait until all the way in next tax season in order to realize that tax deduction. But if you spend it before the end of the month, then you can get the benefit of that tax deduction when you go to file your return upcoming here in the next couple of months in April. So go ahead and take a look at your business. What are your expansion plans? And is there any new equipment or tools that you can buy? Is there a new vehicle? Does your fleet of vehicles need to be replaced and upgraded? Okay, answer that question. Then go ahead and take a look at your existing equipment and vehicles and office supplies and whatever. Any of that stuff, can it be repaired? Are there any repairs and maintenance expenses, that we're going to have to do it anyways? So might as well do it before the end of the year. Go ahead and do that. Another option that you have is to prepay 2024 expenses. This is a little bit kind of like just what I was talking about, right? If you're thinking about buying a piece of equipment in early 2024, buy it before the end of 2023 so you can realize your tax deduction faster. So prepaying expenses, go ahead and take a look at your 2024 expenses, right? Liability insurance, anything related to maybe accounting fees. Always got to squeeze that one in there, right? And then, maybe you need some office supplies. You got to pick up some more pens or something like that. Are there any expenses as of right now that you know for a fact you're going to pay in 2024? Can you prepay those? Can you prepay those before the end of the year? Because then to you get your tax deduction when you go to file in April of 2024, instead of waiting until January or February to pay it. Then you have to wait all the way until 2025 to get the benefit of that tax deduction. So think about your expansion plans. Are you going to buy any new equipment? Can you do it before the end of the year? Look at your current equipment stuff that you have, office supplies. Does any of it need to be repaired? Can you do it before the end of the year? Take a look at your 2024 expenses, insurance, subscriptions that you might have to, QuickBooks maybe, or anything. Can you prepay those before the end of the year? Another one is for all of the work that you do in December. If your customer doesn't pay you before the end of the year, then you're not taxed on that income. Okay, so maybe it goes like this. You're a contractor, you finished up the job, and you're going to collect the 50% of your deposit. You finish up the job on December 20th. You send out the invoice on the 21st, right? The customer owes you, we'll say, $2,000 for the other half of this project. If they don't pay you until January 1st or thereafter, then you do not owe tax on that $2,000. You billed them for it. The customer owes you. You earned it. However, because you have not received that payment, you do not have to pay tax on that $2,000. So what that does is it's the opposite of, prepaying expenses where you're delaying revenue. Okay, you're delaying income recognition. One of the main things, ideas of tax planning is you want to accelerate tax deductions and defer taxable income. You can accelerate tax deductions by investing in equipment before the end of the year. You can do depreciation deductions that way, bonus depreciation in Section 179. You can accelerate tax deductions, repairing old equipment, prepaying expenses. You're accelerating deductions. You're grabbing deductions from the future, so to speak, and bringing them into today. And then you're deferring revenue. You're deferring income by delaying customer payments, right? So overall, you want to accelerate deductions and defer income. Those are the two main goals around tax planning. So those are pretty much what you're going to want to do as a business owner is, take a look at your business, go through those things. What are your expansion plans? Is there anything that you can repair? Is there anything that you can prepay? And okay, so maybe you'd look at all those things and okay, that's one box. We got that checked. What's the next thing that we can look at in order to save some money in taxes? So the next thing that I would say comes down to investing. And there's kind of three things here related to investing that can kind of help you save in taxes. So after you've, dissected all of the moves that you can make, so to speak, in your business to minimize your tax bill, then you kind of come outside of the business and kind of take a look around at what else might be available to you. And like I said, one of those things that investing is the next thing to look at, and it kind of stems off into three branches. So under the investing umbrella, so to speak, maybe you're going to want to look at starting up another business, taking some money out of your current business, right, and starting another business. Maybe it's in rental real estate. Maybe it's in the short-term rental space. Maybe it's another, business that you and a friend are going to go in on or something like that. That, again, that will have its own tax implications related to that, right? Depending on your income level, rental income can generate taxable losses, right? And then that can come in and reduce your other income, okay? Maybe, and we've seen this a lot, is, you have one business that's kind of cash cowing, we'll call it. It's just got a huge taxable profit. We're doing everything we can inside of it in order to minimize the tax bill, but we just make too much damn money. So, but then I've got another business over here that's kind of more in the startup phase where we're growing like crazy. We're constantly buying new stuff. We're constantly repairing. And maybe, the revenue and the income's not quite all there yet. So it's got taxable losses. So you make an investment into a second business venture that's losing money in the early stages, right, for tax purposes. And this loss comes in and helps reduce your other income. So, one thing to maybe look at is there another investment that you're looking to make? Is it in rental real estate? Maybe it's another business with a friend? How is that business going to report its income for the year or for the next couple of years? And how is that going to offset your cash cow of a business? And how can that maybe help you reduce money in taxes? So, yeah, another step after you've looked at your one business is to look at investing in another business of a certain type. But maybe that's not, you're good with your one business for now at least. And okay, so what are your other options? So that's when we'll kind of take a look at, 401k contributions and IRA contributions. If you're a business owner who is a solo operator, meaning you don't have any employees, one option that's really popular is a solo 401k. This allows a business owner to put up to, depending on how all the numbers shake out, they can put up to almost $66,000 into a 401k in, 2023. So essentially, in 401k contributions are tax deductible. And honestly, putting money into a 401k or a traditional IRA is one of the best forms of tax savings because the money's still yours, right? Usually when you get a tax deduction. You have to spend the money, and then the money usually doesn't come back, right? I go and I buy pens for my accounting firm. The money doesn't come back after I buy the pen. Not directly, right? Money doesn't come back after I buy the pen. The money's gone. I now have a pen. That's what I have. I got my tax deduction for the pen, but I lost the dollar that I paid for the pen, right? In a retirement contribution, you take your dollar and you put it in the 401k, you get your tax deduction, and you still have the dollar. Sorry, I actually have a dollar. You still have the dollar, right? Whereas I traded a dollar for the pen and I lost the dollar, I got my tax deduction for the pen. In a retirement contribution, you take the dollar, put it in the 401k, and you still have the dollar. So 401ks, if you are like I said, a solo entrepreneur, you don't have any employees, a solo 401k can be really advantageous for retirement savings and tax savings as well. Like I said, you can put up to $66,000 into the account in any given year. The other option outside of a solo 401k would be a SEP IRA, SEP IRA. It's a little bit different. The contribution limit, I believe, is somewhat similar to that of a solo 401k, or it might be a little bit less. Somebody who would want to use a SEP IRA, this would be, somebody who probably has employees, right? You can't have a solo 401k and have employees. You would have to have a regular 401k. So, in the administrative requirements of having a solo 401k or a 401k plan as a business owner are a lot higher than setting up something like a SEP IRA. So those are the two most popular types of accounts for business owners who are looking at retirement savings: solo 401k and SEP IRA. Both of these accounts let you put, we'll just say, somewhere in the neighborhood of $60,000 a year into this as a retirement contribution. And again, you get to take the tax deduction and the dollar is still yours. So these types, it's like the simplest thing that, saves you money in taxes, right? Put more money in your 401k. Put more money in your IRA. And it sounds so boring and simple, but it's honestly one of the best forms of tax savings. So let's just recap real fast. You got your books up to date. Then you start asking yourself questions. What are my expansion plans? I got any old equipment that I can repair? Can I prepay any expenses? Can I delay getting payments from customers? Okay, you did all those things. Now we're outside of your one business, okay? Now we're in the investment category of what can we do to maybe save some money in taxes. First one under the investment category was start up a new business. Could be rental real estate, could be a partnership with your buddy, whatever. So maybe look at making another investment in the business. If not, or you did that and already exhausted that option, the next option under the investment category is retirement contributions. 401ks, traditional IRAs, solo 401ks, and SEP IRAs for business owners. Put money in your retirement accounts. Pay yourself first. This is paying yourself first. Putting money in your savings account, to go take a vacation is not paying yourself first. It's not. I'm sorry. Paying yourself first is paying yourself first, your future self. You put money in this 401k, you're paying your future self. Your future self will thank you. Because, I'm as optimistic as they come. You're running around here, you're doing all these crazy things in business, you're making these investments over here, you're spending all this time over here. It would be a shame after all that work and all that money that you moved around, right, if you had nothing at the end of it. Put money in your 401ks and IRAs. Do it. So, take a look at your current business. Do you have expansion plans? Can you repair things? Prepay expenses, delay customer payments before the year's over with. Then, once you do that, is there a second investment in the business you want to make? Then, take a look at your retirement contributions. Then, the third one under the investment category would be if you have a taxable brokerage account, which is, an investment account where you hold stocks, mutual funds, and index funds. And the dividends and capital gains on it are taxable. meaning that you own these things and they're not inside of a 401k or an IRA or anything like that. You just have this brokerage, you just have this stock account that has those in it. If you have one of those, you can take a look at doing something that's called tax loss harvesting. What is that? So when you own a stock, we'll just say, for example, for a period of time, what happens to the stock, right? It goes up, goes down, goes up, goes down. So let's say that you have a stock that's been given you, that you've been putting money into every week for the past 2 years, and you've got a total basis in it of $10,000 or something like that. Because you were buying the stock while it was fluctuating, right? There might be certain shares of that stock that are technically at a loss, right? Because the stock goes up like this, and as you're investing, you're buying the highs and you're buying the lows and you're buying the middles. So, this week you bought a high, next week you bought it at a low. So when you look at your thing in total, your investment's up. But if you go inside that investment, you can have portions of the stock that are actually at a loss. Because, for the past 6 months, it was up, 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 up. You were buying, 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 buying. In the past 3 months, it's been down, 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 down. So these shares that you bought over the past 6 months are technically at a loss. What you can do is you can go inside and you can sell off those shares that are at a loss, right? Even though your total stock investment is at a gain, right? You have certain shares that are at a loss, so you go ahead and you sell those shares in order to recognize a tax loss. Did you lose money? Not in total, you did on those shares. So if you sell those shares, you can recognize a loss. You can recognize this loss to the extent that you have other capital gains. So if you have $7,000 in capital gains and you're looking at a couple of your stock positions and you realize that one of them's at a loss, you can take a $5,000 loss and you have $7,500 in gains. That capital loss will come in and reduce those capital gains to $2,500, save you money there. Or if you don't have any capital gains to offset with capital losses, I might have said that backwards. If you don't have any capital gains and you sell stock at a loss, you can deduct $3,000 of it against your other ordinary income. And then the rest of it carries over to future years. So that's what tax loss harvesting is. And that is kind of the third thing under the investment umbrella, so to speak, that you can do in regards to tax planning. Tax loss harvesting. I know I was kind of trying to be quick in explaining that. Might have been a little bit confusing, but if you type that phrase into Google, you're going to find tons of stuff about it, and then hopefully you'll be able to find a good article that really explains in more detail what tax loss harvesting is and how it works. So you've just done a lot of tax planning in this video, and we're not done. So you've done all of those things. You've walked through all of those things. Is there anything left to do? Maybe. The other thing that you can look to do is restructuring your business or businesses. And meaning when you restructure something, you're going to be kind of taking a look at changing the character of income, so to speak. So for example, when I was mentioning how you estimate how much you might owe in taxes for your business, if you're a contractor who does flooring and you have $90,000 in profit, or if you're in rental real estate and you have $90,000 in profit, that $90,000 is going to be taxed a lot differently for the both of you, okay? And let's say that you are a single owner LLC, or maybe you're in a partnership, but that's it. You're just in the LLC and it's a standalone LLC, that's it. And you have $90,000 versus an S corporation that has $90,000 in profit. That's going to look a lot different. So the other thing that you do once you kind of, we'll say, dive inside, and then as you start to then climb your way back out, right? You dive inside, get your books up to date, figure out how much money you're going to make, then take a look at your current business, buying new next year. Are we expanding? Repairing old? Prepaying expenses? Delaying customer payments? Then we climb out to another level and we take a look at investments and other investments, a second business venture, retirement savings, tax loss harvesting. And we climb out again. Now, again, we're going, the scope gets bigger every time as we climb out. Okay, now we're at the highest level and we're looking at restructuring the business. This could be taking your single owner LLC and changing it to an S corporation. This could be taking your multi-member LLC and changing it to an S corporation. This could be something like setting up a self-rental. Your business uses the pole barn in your yard. You can set up a self-rental from your business to take what is, we'll say active income from your flooring company, and then you pay yourself a rent payment, and now you just shifted that income from active income to rental income, which generally has more favorable tax treatment. So those are some things that you can look at. S corporations and maybe some self-rentals. And if you're in the short-term rental space, you look at materially participating in your rental property or not materially participating in your short-term rental property. And that question shifts income from passive to non-passive. A lot of this, those two things get taxed very differently. So maybe it is time to look at an S corporation. If that is you, in 2023, you're kind of too late, right? You might be able to set it up for 2024 though. If you want to do something like the self-rental thing, you rent your pole barn to your business, again, that'll probably have to be a 2024 thing. It's a little bit too late. But that's kind of, basically the year-end tax plan that you kind of walk through in order to help you best plan your tax situation. And those are pretty much the things that you can do in order to save money in taxes. Optimize your after-tax cash flow. So it is almost tax season. I hope this video helps. I hope it reaches you in the right amount of time before the ball drops. Because one thing that we always don't like is when after the ball drops, it's pretty much too late. Can't change your tax situation. So that kind of is what it is. Anyways, I hope this video helped. Get ready for tax season. Get more on top of your stuff. You're a business owner. What are you doing? I know, you're out there making money. I get it. Make the money, count it later. Take it easy.